Okay, so this is video number 2 for chapter 14. Please make sure to refer to video number 1, which talks about some of the basic concepts relating to common stock and preferred stock. And here we're going to be talking about some additional issues related to stockholders' equity and other types of equity transactions. So, the first concept we're going to be talking about is reacquiring common shares. So, again, here's some of the reasons you might find for a buyback. The company may want to invest in itself because it feels that the stock is undervalued. You also may want to go ahead and buy it to maintain control, as an example. One of the things that sometimes you've probably seen, or in the movie, for example, Pretty Woman, if you remember the Richard Gere character, he was out there and he was trying to take over a company. And one of the conversations they had in the movie when he was talking to the actual investors of that shipbuilding company, they said they were going to buy back their own shares in order to maintain control of the company. So sometimes when a company feels it's under attack, it may start buying back its own shares to make the company less attractive to an outside attacker, if you will, somebody else that wants to try and invest in the particular company. So when a company reacquires its own stock, the term is actually called treasury stock. And as you're seeing here, treasury stock is not an asset. Okay, so treasury stock, it's a debit on the company's financial statements, but it's not an asset. It's actually a contra stockholders' equity account. Okay, so equity normally sits as a credit balance on a company's books. Treasury stock is a debit balance, and it's not going to be on the asset side. It's going to be as a contra stockholders' equity. And basically, treasury stock can be used again to buy and to resell at a profit. It can be bought to be issued to corporate shareholders. I'm sorry, to corporate employees for stock bonuses, as an example. And there's different reasons out there. But one of the things that you need to understand is that when these treasury stocks are acquired, these shares are no longer considered to be outstanding stock. Okay, so therefore, these treasury stocks that are bought back by a corporation, they do not receive dividends. They are not entitled to vote, and so forth. Okay, so they basically lose some of the rights that a normal outstanding common stock would receive. Okay, and then they talk here about the two acceptable methods that basically are used to reacquire a company's stock. Okay, so purchase treasury stock. And the one that is, it says here, more widely used, which is the cost method, is by far the one that is more widely used. As a matter of fact, for the most part, the par value method is rarely used and rarely even taught by most publishers. Okay, so here, to give you an example, Pacific Company issued 100,000 shares of $1 par value common stock at a price of $10 per share. In addition, it has retained earnings of 300,000. The company's equity section at December 31st, 2024, before the purchase of treasury stock, is shown here. On January 25th, 2025, Pacific acquires 10,000 shares of its stock at $11 per share. So again, when a company buys its own treasury stock, they have to pay market value for these shares, regardless of what the par value was. Okay, so in this particular case, they bought 10,000 shares at $11 per share. That's $110,000. Okay, again, you're going to debit treasury stock, you're going to credit cash. Okay, so if the company had purchased someone else's stock, it would be, investment in stock, debit, credit cash. Here, it's investment in treasury stock, if you want to call it. It's not really an investment, but it's a purchase of treasury stock, so it's also a debit, and you're going to credit cash similar to what you would have done if you were buying someone else's stock, except that if you bought someone else's, it's in the equity section. I'm sorry, in the asset section. If you're buying your own, it's a contra equity account. Okay, so here you're seeing what that contra equity account would look like. Okay, so it gives you here paid in capital retained earnings before treasury stock, less treasury stock. So again, contra equity, and that's going to get you down to total stockholders' equity of 1.1 million 90. So again, to make sure we understand, treasury stock is similar to an investment that they would have been buying from another company, but if they're buying their own shares, it doesn't sit in the asset section. it's going to sit in the equity section. Now, again, I mentioned some companies may buy treasury stock to pay to employee bonuses or for different reasons, but sometimes they buy the stock because it's undervalued. And hopefully, the bet would be that they buy a stock at whatever price it is, they hold on to that stock for a little while, and they decide to subsequently resell it. Again, hopefully for a gain. They could obviously sell it for a loss, but either way, when they do sell treasury stock, you're reducing that contra equity. Okay, so in that particular case, whether when you do sell it, whether for a gain or a loss, which you'll see in a minute, they don't really have gains or losses. Okay, so it's basically termed above cost or below cost, the cost that they paid for it. They are still going to both increase total assets and stockholders' equity. So again, situation here, they bought 10,000 shares at $11 per share. It's now going to sell 1,000 of those shares at $15 per share. So the actual market value of the stock has gone up from 11 to 15. So Pacific says, let's go ahead and sell 1,000 of the shares that we own for 15. And in theory, they have made $4,000 of profit. But just to make sure it's totally understood, when a company sells its own treasury stock, you do not record a gain or a loss, depending on whether you sold it above or below cost. You basically are going to debit your cash. You're going to credit your treasury stock at your original value that you paid for it. You originally paid $11 per share. You sell 1,000 shares. You're going to get rid of $11,000 from the treasury stock line item, and that $4,000, gain or profit or whatever it was, it's not going to be reflected on the income statement. It's just going to go immediately straight to stockholders' equity, and it's going to go into an account called paid in capital from treasury stock. So again, if you make money by reselling treasury stock, it goes to an account called paid in capital from treasury stock. Okay, so this is assuming you sold it for a higher price than what you paid to originally acquire it. So here later on, you sold an additional 1,000 shares, but not at $15 per share. Now the stock has gone down and you sell it at $8 per share. Okay, so again, your original acquisition price was 11. You're now selling it at 8. You, in theory, lost $3 per share. Okay, so you sold it below your cost, and you're going to have lost $3,000 in the particular case. Again, you're going to debit cash for the amount, the number of shares sold times the market value, 8,000. You're going to credit treasury stock at your cost basis times the number of shares sold, 11,000. And this $3,000 quote unquote loss. Okay, so remember, expenses are debits, losses are debits, revenues are credits, gains are credits. So this, again, loss, which does not go through the income statement, okay, it's just a direct amount of a loss that goes straight to stockholders' equity. It's going to go against the same account we saw in the previous slide, paid in capital from treasury stock transactions. Okay, but remember, the previous slide, we had $4,000 balance. So to the extent that we have a balance in paid in capital from treasury stock transactions, any losses that we subsequently have will reduce that paid in capital from treasury stock transactions. So again, we had originally in the previous slide had a $4,000 above cost sale. Now we have a $3,000 below cost sale. So after we're done here, we're going to still have 8,000 shares of treasury stock and at $11 per share. And we're also going to have a net of $1,000. This 4,000 here against this 3,000 there, which is going to be in paid in capital from treasury stock. And remember, that's going to be sitting as a credit balance. Okay. So purchase of treasury stock, sale of treasury stock, again at cost, sale of additional treasury stock at cost. Here was the $4,000 that we made on this first sale, and here's the $3,000 that we lost on this second sale. So the net amount remaining unpaid in capital from treasury stock is going to be $1,000. Okay, so again, it's just giving you some additional information. You can go ahead and pause these slides and take a look at it, but it's just basically reflecting what these transactions would be based on the purchases and sales of treasury stock and so forth. Retiring treasury stock. So again, all accounting books basically have this as an example. The reality is that most companies usually do not retire treasury stock. Okay, so if you do, it's basically going to reduce the number of shares issued. Okay, so remember, there's authorized, there's issued, there's outstanding, and the difference between issued and outstanding is treasury stock. Okay, so a treasury stock is considered to be issued, but no longer outstanding. Only common stock that's not reacquired is to be considered outstanding. So if you do, for whatever reason, reacquire some shares, if the company were to reacquire them and then retire them, at that point, the number of shares issued and outstanding will go back to being equal again. So again, generally, this is not something you would normally see on a quiz or an exam. It might be something that pops up, but the reality is that when you do this, you're going to basically reduce the amount of common shares outstanding. You're going to reduce the paid in capital from common stock, and you're going to reduce any retained earnings to the extent that you need some additional amount to offset the amount of treasury stock that you're basically retiring. Okay, so again, this is an example here. March 4th, they issued 200,000 shares of $1 par common stock for $1 million. So you're going to have par value, 200,000, additional paid in capital, 800,000. Okay, to make up the full $1 million that you received. On September 10th, you bought back 2,000 shares at $6. So you're going to debit treasury stock for $12,000. You're going to credit cash. October 15th, you're going to sell 1,000 of those shares for $8. So you're going to have a $2,000 gain, if you will. Okay, so you remember you bought it at 6, you sold it at 8. So you can have a $2,000 gain because $2 times 1,000 shares. And the remaining shares were retired. Okay, they retired the remaining shares of Treasury, which was the additional 1,000 shares. And here is the the list of all the different journal entries of how they look like. Again, normally we don't deal too much with the retirement side, but the other items you are seeing here are pretty common things that you might find in homework and or in quizzes and exams. So again, there are different types of dividends here. There's property dividends and liquidating dividends. For the purposes of this particular class, we're not going to be covering those. Okay, we're just going to be talking about cash dividends. And so again, going back to chapter 2, chapter 3, and so forth, we talked about the fact that retained earnings is revenues minus expenses minus dividends. Okay, so dividends basically reduce stockholders' equity as part of, as it goes through retained earnings. Okay, so for dividends, we basically have three dates that we need to focus on. Okay, there's a date of declaration, the date of record, and the date of payment. Okay, so again, generally a larger corporation will have three different dates. Small corporation, they may just go ahead and issue a dividend and pay it out on the same day. But for larger corporations, for the publicly traded companies, they'll have these three dates: the date of declaration, date of record, and date of payment. So again, to explain how this works, many times what you'll see or read in the paper or on CNBC, whatever it is, they'll say that here it says Roadway Freight Company is going to declare a dividend on June 10th for shareholders that own stock, the company stock, as of June 24th, and that dividend is to be paid out on July 16th. I'm sorry. So if they declare the dividend on June 10th, that's the day that you reduce retained earnings. Remember, dividends reduce retained earnings. Dividends are debits. And notice on this day, there's no cash being paid. Okay, on the date of declaration, there's no cash. You establish a dividend payable liability. Liabilities grow on the credit side. What does that mean, though? That if on June 10th I don't own any shares, and on June 23rd, okay, June 23rd, I buy shares of Roadway Freight Corporation, and then on June 25th, I sell those shares. That means I did own them as of June 24th. I'm going to be a shareholder of record as of June 24th, which means that even though I do not own the shares on July 16th, okay, I'm going to receive cash. Okay, so July 16th, all that happens there is that my dividends payable gets satisfied through cash, but retained earnings goes down on the day you declare the dividends on June 10th. Okay, so a lot of times people get confused and they think that dividends reduce retained earnings the day it's paid. It's not. It's reduced on the date it is declared. So earlier in this chapter, I had mentioned the fact that preferred shareholders kind of receive a almost similar to like a CD. They receive like a percent, okay, a certain percentage that's been promised as part of the actual preferred stock offering. Okay, so in this particular case, it says that it has 500,000 shares of $1 par value preferred stock, 7% cumulative. Okay, so I mentioned earlier about the concept of cumulative. Cumulative means that if there's any dividends that were not paid in previous years, when the company does finally decide to pay dividends, all amounts that were previously skipped, or the term is previously passed, will be paid to preferred shareholders before common shareholders receive anything. Okay, so again, they're telling you here that Citigroup did not declare any dividends in 2024. So in 2025, they said they're going to go ahead and pay dividends. So what happens here is that you're going to go back and say that the preferred shareholders are going to receive the 2025 dividends and the 2024 dividends. They're going to receive 7% of $500,000. 7% of $500,000 is $35,000 in preferred dividends. Okay, preferred dividends. So here's the 35,000 for 2024. That's in arrears. Here's the 35,000 for 2025. That's the current year declaration. And in this particular case, the preferred shareholders will receive $70,000 in dividends before common stockholders receive even $1. So something else a company sometimes does is that it pays stock dividends. Okay, we talked about cash dividends, which is the most common type of dividend out there. But occasionally, a company's stock price is doing very well, and what they'll do is they'll go ahead and say, "Hey, listen, we're going to pay a 5% stock dividend, a 10% stock dividend." Okay, so what ends up happening is that when they do that, they say if a stock dividend is less than 20 to 25% of the common shares outstanding, the company will debit retained earnings for the fair market value. The fair market value, okay, less than 20 to 25%. They will basically declare a dividend for the fair market value of the stock outstanding. Okay, and that's basically 20 to 25% is considered to be a small stock dividend. So again, here's an example of a small stock dividend. Company has 1,000 shares at $1 par, and it's going to declare a 10% stock dividend. So 10% of 1,000 shares, 10% of the 1,000 shares is 100 shares. And because it's a small stock dividend, you're going to use fair market value of the stock. The fair market value is $130 per share. So 100 shares issued at $130 per share means that your retained earnings, again, you're going to debit retained earnings for the dividend, $13,000, but you're going to go ahead and put in 100 shares at $1 par in the common stock line item, and the additional $12,900, which is the difference between the $100 and the $13,000 dividend, that amount goes to additional paid in capital. Okay, additional paid in capital there. So if you basically had a situation that the actual amount was considered to be a large dividend, it would just simply be at par value. But because it's a small stock dividend, less than 25%, you do it at market value. I'm going to go ahead and so now we're seeing an example of a large stock dividend. Again, I just mentioned in the last slide, but what happens here if the amount of the dividend is greater than 25%. So in this particular case, this example says that it's paying a 30% stock dividend. Here, you do not use fair market value. Here, what you're going to use is par value, okay? So you're going to take the par value in this one. Fair market value, this doesn't matter, okay? If it's larger than 25%, it's a large dividend, you will go ahead and pay out number of shares issued times par value, and that becomes the amount of your dividend. Okay, so you do not need to worry about the fair market value. You don't need to worry about accounting for additional paid in capital. Okay, it's just simply going to be dividend and common stock. Stock split. So what happens with a stock split is that a company basically decides that maybe the price of its stock has maybe gotten too high. And a lot of times people want to go ahead and list or have their stock traded at a nice sweet spot. Okay, so it's actually happened not happened more frequently in the last few years where you've seen a stock like Tesla, which has done very well. That Tesla stock has had stock splits. And Apple, which has done very well, has also had stock splits. So in those particular cases, what they're basically telling you here is that before the stock split, let's say this company had 1,000 shares with a $100 par value stock. After the stock split, you basically are going to double the shares, okay? Shares times 2 and par value divided by 2. So here you're going to have now 2,000 shares at $50 par. So 1,000 shares at $100 par equals 100,000. 2,000 shares at $50 par equals 100,000. But normally what happens is that the trading value on the street of that stock will basically be reduced. So if the previous market value of the stock was $1,000 per share, after a 2-for-1 stock split, it normally will drop to about $500 per share. Again, making that stock more easily affordable by people on the street than if it was selling at $1,000 per share. So that's one of the main reasons why you see stock splits taking place. Okay, so again, here's just a summary of all the information, whether it be cash dividend, paying the dividend, small stock dividend, large stock dividend, and so forth. And stock splits, which you see is basically nothing. Okay, so again, this is something you can look at on your own. It's an example of a company that had paid the cash dividend and also basically had a stock dividend declared, a $5 stock dividend, and then it had a $100% stock dividend, and so forth. So again, all the information we've been seeing in the last few slides are all being included here, and it's asking you for the journal entries. Take a look at this at your own time. Again, you will see examples of these types of questions on the quiz. You will see examples of this in the homework and on the exam. Okay, and here's what the entries look like. And then finally, the different types of preferred stocks and dividends. It says here in 2025, Mason Companies to distribute $50,000 of cash dividends. Its outstanding common stock has a par value of 400,000, and its 6% preferred stock has a par value of 100,000. If the preferred stock is non-cumulative and non-participating, okay, normally for the most part you will see that the preferred stock will be cumulative. But if you're seeing something listing as non-cumulative for any particular reason, what they're basically trying to tell you is don't worry if you've had anything in arrears, because non-cumulative means that if there was any preferred stock dividends not previously paid, they lose it, which is why it's almost never seen. But for the purposes of this class and the purposes of the quiz and the exam, again, you'll want to go ahead and maybe if you see the term non-cumulative, it means don't worry if there's any dividends in arrears. There really will not be anything in arrears because any non-paid preferred stock is going to be passed. Okay, so in this particular case, they're saying that it's going to distribute $50,000 as cash dividends. Preferred stock is 100,000, 6%. That means 6,000 goes to preferred. They paid 50,000 in total. 50,000 minus the 6 means that 44,000 goes to common. And here's the $50,000 in total dividends. Again, 6,000 goes to preferred, 44,000 goes to common. And so again, here we're going to see that it was actually cumulative. Okay, it's cumulative preferred stock, and they're saying here that it did not pay dividends on preferred stock in the preceding 2 years. So that means it has to catch up the dividends missed for the previous 2 years plus the current year dividend. Okay, so in this particular case, it's the same $50,000 to be paid out in dividends, same $100,000 par, 6%, which means that it's going to be $6,000 in preferred dividends per year. It tells you again, it did not pay for the preceding 2 years, so here's 6,000 for the previous 2 years. Here's 6,000 for the current year, and that means that 18,000 goes to preferred before common gets anything. But since they actually declared a $50,000 dividend, you're going to take the $50,000 minus what went to preferred, and that leaves $32,000 for common shareholders. Okay, and that's it for chapter 14. Again, make sure that if you did not watch it already, to watch part 1 of this particular lecture, which is the separate video. And that's going to be it for everything related to stockholders' equity. Good luck, everyone.